Good evening. I'm Gavin Cleesby, the Director of Programs, Exhibitions, and Community Partnerships for the Massachusetts Historical Society, and I'm happy to welcome those of you who've made it in person, as well as all the people who are joining us online. For anyone who might be visiting the Mass Historical Society for the first time, we are the first historical society in America. We were founded in 1791, and as I like to say, we were founded so long ago that when we were founded, our founding director wrote to Paul Revere, and Paul Revere wrote back. We hold close to 14 million manuscript pages in our collection. These include the papers of 3 of the first 6 U.S. presidents, including John Adams, John Quincy Adams, and the largest collection of the private papers of Thomas Jefferson. And for the past 232 years, we've been making all this material available to the public and to researchers for free. We also host a wide variety of programs. We're only able to host programs like these thanks to the support of our members and donors. So we hope that you'll return for future events. And we hope that if you enjoy this event and future events, that you will consider becoming a member and supporting our work. This evening, we're happy to welcome Dr. Sharon Ann Murphy, who will be discussing her new book, Banking on Slavery, Financing Southern Expansion in the Antebellum United States. Dr. Murphy received her BA, MA, and PhD from the University of Virginia. She is a historian of the 19th century America with a particular interest in the complex interactions between financial institutions and their clientele, looking at why financial institutions emerged, how they were marketed, and how they were received by the public. This evening, she will be discussing her new book, Banking on Slavery, which examines the critical role played by Southern banks in supporting and promoting the system of slavery on the frontier, particularly through the use of enslaved lives as loan collateral. So without further ado, please join us in welcoming the speaker.
Thank you so much. I'm told that thank you all for coming today. I'm told there's quite a few people remote as well. So thank you all for joining us. First of all, I'd like to thank Gavin for that kind introduction and for everyone at Mass Historical Society for inviting me to give this book talk. I first gave a talk here back in 2010, actually in the room downstairs, as part of the Boston Early American History series. And before the pandemic, I would often come for various seminars and brown bags. And so I've always found Mass Historical to be a very welcoming environment. But this book is actually not what I was working on back in 2010. At that time, I had just published my first book on the antebellum life insurance industry. And I had started a new project on the public perception of banking during the Panic of 1819. And that's actually what I presented on here, even though that's still in progress. I also had a newborn at home, so I was trying to frame my second project primarily around newspaper databases and other online sources. So yeah, she's a cutie. She's now going into high school, which is really scary. And while I struggled to frame this second project and had a second baby, my editor asked if I would be interested in writing a book on how money and banking worked in the early republic. And after giving it some thought, I jumped at this opportunity for 3 reasons. One, it would force me to really dig into all the scholarship on early American banking, almost like a grad school style prep for comprehensive exams on early American finance. Second, since this book would be mainly based on secondary sources, I could write it without traveling to archives. Again, babies. And third, it would give me the opportunity to produce what I like to call a useful book. So whereas I was trained as an economic historian, most historians don't have this background. And thus they tend to approach economic topics in history from more familiar grounds. So from the perspective of politics or labor or class, but they really don't get into the ins and outs of the economy itself. So the second book, Other People's Money, was my attempt to teach basic financial literacy of antebellum America to a very broad historical audience. So after finishing this book, my original intention was to return to that project on banking during the Panic of 1819. But as I was writing my section on the relationship between banking and slavery, I was struck by how anemic this discussion was. And you can see here, it is literally 3 paragraphs was all I had for this book. Very few secondary sources broach the topic at all. The few that did discuss slavery tended to focus on the short-lived plantation banks, which were a very specific type of property bank during the 1830s. Others examined the relationship between large merchant bankers who would eventually evolve into an investment banking industry and the global cotton trade, for example. Others looked at the use of enslaved people in more general credit transactions, largely outside the formal banking industry. On the other hand, the major scholarship on commercial banking, even an extremely important, prominent monograph on Southern banking, made almost no mention of slavery. Was there really no substantial connection between banking and slavery? I decided I had to put aside that project on 1819, at least temporarily, and dig into this new question. Of course, this also meant I actually had to go back to the archives. So sorry, kids, mom's traveling. I traveled to dozens of archives all throughout the South for this project, which is kind of fun. I specifically, though, wanted to focus on those ways that Southern commercial banks directly, knowingly, and explicitly interacted with the slave system. So although a lot of historical work of late has been talking about all the indirect ways that parts of the country are built on slavery, I wanted to really focus on a direct connection to narrow it down. Now, at this point, I should probably back up and explain a little bit of terminology, because if you don't understand the terminology, you're not going to understand the main argument of this book. So a commercial bank, and I have a former student here who's had this slide before in the past. So a commercial bank is a type of financial intermediary, meaning that it's facilitating the exchange of funds between creditors, people with money, that they're willing to lend, and borrowers or debtors who are seeking loans. And so in the antebellum period, commercial banks were chartered through individual acts of incorporation by each state. These are state local banks. And those charters granted them the privilege of issuing banknotes and decided the basic terms of lending that they were allowed to engage in. The First and Second Bank of the United States also operated as commercial banks, but with federal charters and with branches throughout the United States. Now, in the southern states, banks were typically large state banks with branches throughout the states. In the north, these were typically smaller unit banks with no banking privileges. But other than that, they were very similar in how they were structured. Now, commercial banks accumulated loanable funds in two ways. First, through the sale of bank stock, and second, by receiving money on deposit. And today, most bank funds come from deposits, but back in the antebellum period, actually, most of the funds are actually from the sale of bank stock. And then they use these funds to make loans, although they're not going to be lending out gold and silver that's in their vaults. Instead, they're going to be lending out these banknotes that they are issued by these individual banks and are technically redeemable on demand in specie. But the details of banknotes are really unimportant to my story, so I'm not going to get into that. It's a whole nother story, but I'm going to put that aside. Okay. The most common type of lending that was engaged in by commercial banks in both the North and the South was something called discounting. This is a very specific type of short-term loan, mainly for business people engaged in trade. So a merchant would obtain goods from a seller, and they would issue a promissory note, often referred to as commercial paper, promising to pay the full amount at some future date after they had, for example, sold the goods in question that they had just purchased. The seller could add their name to the note, making it double name paper, and then they could go to the bank and they could get money from the bank by discounting this note. The bank would loan them the face value of the note. So in this case, it's $43, less a discount, which reflected the interest rate. So they're taking the interest rate off beforehand. Most of our loans, we add the interest rate on. In this case, they're taking it off. So for example, a typical bank charter from this period stated, the president and directors may discount notes or bills at any length of time, not exceeding 60 days, but may renew the same from time to time at pleasure. So the charters themselves explicitly define the lending terms of the bank. Proponents of sound banking asserted that discounting was the safest type of loan because these loans were backed by quote unquote real commodities. So goods in transit or items awaiting sale or a harvest about to be shipped and so forth. These loans were all short term, usually only 30 to 60 days. And they were self-liquidating, meaning that as soon as the sale is completed, the note would be repaid. In actuality, these notes were often renewed, but the bank would require the payment either of an additional discount with each renewal, or at any point the bank could decline to renew the note and demand payment in full. And these features, particularly the short-term nature of these loans, made these loans of little use in the agricultural sector. So most banks were chartered for urban areas and tended to serve mercantile clientele. These features also made banks of little direct use for the slave economy. Again, I'm not denying or downplaying the numerous indirect ways that banks supported slavery. So, for example, the financing of trade in goods produced by enslaved people. But bank financing of the international cotton trade, for example, could have occurred in a counterfactual universe without slavery. It wasn't directly related to slavery. So my focus in this project is about those direct interactions between commercial banks and slavery. And this traditional structure of commercial banks didn't make them very useful to the slave economy during the first 2 decades of the 19th century. However, even if these traditional commercial banks did not initially promote and directly support the slave economy, many of these banks still indirectly interacted with the slave system. So if the debtor failed to repay the loan, the bank could sue the debtor and anyone else who had endorsed that note in question for repayment. And the court would issue an order called fieri faciis, or FIFA for short, which allowed the sheriff to seize any property of the debtor or any of the endorsers in payment of this delinquent obligation. And so it's through these FIFA judgments that early banks first engaged directly with human property. Southern banks willingly seized and sold enslaved people as part of these foreclosure proceedings. Second, if a debtor wished to renew a discount loan, as I said, the bank could say you have to pay another discount, or they could ask for additional security to secure that loan. So, for example, most bank charters in both the North and the South, again, allowed institutions to hold property that, quote, shall have been bona fide mortgaged or conveyed to it by way of security, or in satisfaction of debts contracted in the course of its dealings. And so, in the South, banks regularly accepted enslaved people as mortgage collateral for the securitization of existing short-term loans. Thus, these traditional commercial banks were certainly interacting with the slave system, even if they were doing little to directly support or further the expansion of slavery. By their nature, traditional commercial banks were conservative entities that did not provide the type of financial assistance needed by most slaveholders, namely long-term loans in larger amounts than what was permitted by most banks and backed by landed or enslaved property. So in the settled areas of the Atlantic seaboard, places like Virginia, Maryland, North Carolina, South Carolina, most banks would maintain this conservative focus throughout the antebellum period. But the population was rapidly expanding westward during the first decades of the 19th century. And on the southern frontier, where farmers believed that the ownership of enslaved labor was essential to their success, and where much of the region's wealth was invested and stored in these same enslaved bodies, this discrepancy between banking practices and local demands initially hampered growth. Yet during our post-War of 1812 boom, as average slave prices rapidly increased, Frontier bankers in the growing states of Kentucky and Tennessee and Mississippi and Louisiana became increasingly comfortable with actively treating enslaved people as financial assets, even as traditional banking norms continue to constrain their support of this westward expansion. So let me just give you one example of this. In 1818, two different Natchez, Mississippi mercantile institutions were indebted to the Bank of the State of Mississippi to the amount of $21,000 in their money. They had accumulated these debts through discounting and repeatedly renewing these discounted business notes. Two of the endorsers, a man by the name of Francis Giroux and another by the name of Charles Green, both of who were prominent citizens in Natchez, also were endorsers on these notes. And when the firms who owned these notes, who owed this money, failed during the Panic of 1819, the bank pursued these two men for payment. And in March of 1820, Francis Giroux proposed a formal mortgage to the bank of both his and Green's property in return for extending the payment over 4 years to allow them to try to pay back this massive amount. And included in the mortgage were several tracts of land in the parish of Concordia, that's the parish of Concordia there, including 12 enslaved laborers, another 7 enslaved men on a smaller property owned in the city of Natchez, Green's Waterloo plantation, which is on Lake Concordia, you see up there, and as well as all the enslaved workforce on that property. And Giroux estimated that all this combined property that he was mortgaging was probably worth about $34,000, so well more than a $21,000 debt. And the men agreed to pay back the loan in 4 equal installments, but they failed to pay it back. And the Bank of the State of Mississippi had to take possession of all of this property, including all of the enslaved lives. And once in the possession of a plantation, banks often had to manage that property as they sought out a suitable buyer. So now you have, banks regularly having to hire a manager owning this property until they can find someone to sell it. Now, despite the massive disruption of the first national panic in 1819, the banking system of the South emerged largely intact. And with only a few exceptions, the business model of all of these banks, including the Second Bank of the United States, the large state-owned banks of the South, as well as the banks in the frontier South, they all remain committed to the short-term commercial paper, even though they would regularly renew this paper and secure it with mortgages on land and human property. Yet a few banks, especially those on the frontier, started actively pushing against these boundaries of traditional banking practices in response to the demands of the slaveholders who needed more funds. And they would allow these businessmen to accumulate really large debts and repeatedly renew them using enslaved individuals as collateral. And the largely positive experience of both debtors and the banks with these mortgage contracts during and after the Panic of 1819 convinced frontier bankers that enslaved lives were not only acceptable as collateral, but they were actually superior to other assets. They were more useful. They liked it better than land as an asset, for example. Thus, as we move into the 1820s and 30s, bankers operating on the frontier were increasingly willing to initiate new long-term loans secured by enslaved individuals, and even to finance the initial purchase of plantations and enslaved lives secured by the same property, often in defiance of their charter terms. Yet the financing needs of the people pouring into Western Georgia and Alabama and Mississippi and Louisiana greatly surpassed what these conservative banks could offer, even with their most creative interpretations of the discounting function. For the planters, large long-term loans secured by their plantations and enslaved workers were essential for their survival and growth. State legislatures in places like Louisiana initially tried to work within the confines of traditional commercial banks to meet these needs. So in 1824, the legislature of Louisiana chartered the Bank of Louisiana with $4 million in capital, half of which was owned by the state. Louisiana financed its $2 million portion of this through the sale of state bonds in the Northern and European markets. And while the bank was permitted to discount notes for up to 4 months, twice as long as traditionally permitted, it was actually required to lend at least half of its capital in long-term mortgages of up to $5,000, payable in 5 years, lending in sums of up to half the value of that property. So this is, they're now changing the very nature of banking by allowing these long-term loans secured by slaves. And the rules and regulations for conducting the bank recognize that enslaved people in Louisiana were legally classified as immovable property, and thus could be used as mortgage security for these loans. Headquartered in New Orleans, the Bank of Louisiana opened 3 branches in the cotton-producing parishes of the state, as well as 2 other branches throughout the state, but they concentrate in the cotton-producing areas. The following year, the legislature revised the charter of the older Louisiana State Bank, also allowing it to issue long-term renewals of discounted loans, as long as they secured it with adequate mortgage collateral. This shift to long-term property lending had a substantial effect on the credit options of planters in Louisiana. Large mortgages directly secured by land and human property became the norm for institutions like the Bank of Louisiana. So according to its charter, the bank loans were limited to $5,000 per individual, but in practice, the bank regularly approved loans of 4 to 5 times this amount. For example, one slaveholder in March of 1830 received a $20,000 loan secured by a mortgage on his St. Charles sugar plantation and 49 enslaved workers, which he would not pay off until 8 years later. The following year, the bank lent the same amount to another pair of planters on their plantation and 58 enslaved workers in Lafourche Parish. The partners remained indebted to the bank until 1838, when they sold the plantation to other slaveholders who assumed payment of this mortgage. In April of 1831, another pair of slaveholders mortgaged their sugar plantation in Jefferson Parish with 149 enslaved workers in exchange for a $25,000 loan. They faithfully paid off their loan in the next 5 years, fulfilling the terms by February of 1836. Although property loans were supposed to all be paid off within 5 years, in 2 of these 3 examples, they extended well beyond the limit, and that was the norm for them to extend beyond. The Bank of Louisiana regularly permitted longer terms as well as larger amounts than their charter allowed, as long as the debtor continued to at least make partial payment of this loan. And the bank considered the debtor still to be a sound risk. One cotton planter in West Feliciana mortgaged his plantation and 83 enslaved individuals to the bank in January of 1826 in return for a $28,000 loan. And the planter must have consistently paid enough of the principal and interest that the bank permitted it to extend for over 12 years. Finally, in August of 1838, the bank received the full amount of the said loan, and it released the debtor from the mortgage. But even these banking options were not adequate. Louisiana merchants and planters both lobbied the legislature for even more banks. And the legislature finally responded by chartering first the City Bank of New Orleans. That's not there. City Bank of New Orleans, that's on this one, with a capital of $2 million and branches in the cotton growing parishes. Then the Mechanics and Traders Bank of New Orleans in 1833. And then a third commercial bank, the Merchants Bank of New Orleans in 1836. The Merchants Bank, this last one, permitted up to 8 years to make payment of mortgages and specifically listed land and slaves as suitable collateral on these loans. Although it didn't have formal branches, 1/3 of this bank's capital was designated for the planters of the state living outside the city of New Orleans. Now, the one major constituency largely ignored by these new banks was the sugar planters of the state. Although the Bank of Louisiana, the City Bank, Canal Bank all had branches throughout the state, the majority of the banking capital and lending services centered still on short-term commercial paper in New Orleans or the needs of cotton planters. And while cotton and sugar planters controlled vast wealth in the form of land and human property, this wealth's not liquid. It's tied up in the land. It's tied up in the enslaved people. And so that made it difficult to charter new banks on a traditional model. During the 1820s, a series of poor sugar crops, combined with the reduction of the tariff on imported sugar, hit the region really hard. And whereas cotton could be profitably produced on plantations of all sizes, with only minimal economies of scale accruing to larger producers, sugar was very capital intensive to produce. It experienced substantial economies of scale, so you needed large plantations to make it profitable. Successful sugar planters appear to have required a minimum of at least $100,000 in assets. That would be about $2.5 to $3 million today to run a successful sugar plantation. The capital-intensive nature of sugar production left the planters with an unmet need for access to banking services, but large, long-term loans, not these short loans that traditional banks afforded them. Rather than continuing to try to fit the system of slavery into the traditional commercial banking apparatus, Southerners began reimagining the relationship between banking and slavery. And one result of this reimagining was the formation of plantation banks. First, with the creation of the Consolidated Association of the Planters of Louisiana, which was chartered in 1827 with $2 million in capital as a property bank, focused mainly on the plantations and their enslaved workers. So traditionally, commercial bank charters required you to buy capital, buy the stock, and you pay with gold and silver to purchase your shares of stock in order to begin operations. The charters of these plantation banks required no paid-in capital. In contrast, instead, the reserves of the bank were based solely on borrowed money. Investors mortgaged their plantations and enslaved laborers in return for bank shares. And the entirety of the bank's capital stock was based on these mortgages. But this practice still left the bank without any money to actually lend out. This is kind of a problem. And so initially, the CAPL tried to sell bonds to raise the requisite specie. And annual principal and interest payments on future mortgages would pay the interest on these bonds. But investors were wary of investing in mortgage-backed securities. That would be problematic. We may want to think about that. And without having any further security. So the bank appealed to the state for help. And by an act passed in 1828, the state of Louisiana agreed to issue Louisiana state bonds, giving these bonds to the bank in exchange for collateral, the long-term mortgages on these plantations and enslaved lives. The bank then sold these state bonds to investors in the Northeast or overseas who paid the bank in gold and silver. The bond purchasers had more confidence in the securities since they were guaranteed by the state and ultimately the taxpayers. And this specie then enabled the bank to begin issuing banknotes and extending loans on a fractional reserve basis. This financial setup was actually quite similar to how the Bank of Louisiana had been financed in 1824. Yet, in the case of the Bank of Louisiana, the state actually owned the bank shares and they were accruing interest on those shares. In this case, all they're doing is backing the loans, backing the bonds. They only would indirectly benefit from a successful institution. And the state remained confident that the CAPL will be able to pay the interest and principal on these bonds because it's backed by this valuable land and enslaved workers, and it's the booming cotton and sugar economy. What could go wrong? Now, in response to the continued financing needs, the state chartered a second plantation bank in 1832, the Union Bank of Louisiana, with $8 million of capital. And then a third in 1833, the Citizens Bank of Louisiana, with $12 million in capital. You can see they were like, we need it so much. And all of these were oversubscribed. Everybody's like, really trying to get involved in this because the funds were so in demand by the slaveholders in these states. And this model would also be copied in Arkansas, Mississippi, the territory of Florida. Stock subscriptions quickly poured into all of these plantation banks, particularly from the sugar growing areas of the state. And a typical contract with the Citizens Bank of Louisiana is one seen here from 1836 between the Citizens Bank and Bernard Marigny. Marigny mortgaged his sugar plantation in Plaquemine Parish, along with 70 enslaved people. They're listed here by name, by gender, by age. And so they wouldn't just list individual, they wouldn't just list the slaves en masse. They actually listed out who they were putting up for collateral in these contracts. And he mortgaged this in exchange for 490 shares of bank stock. And these shares of stock would then enable him to take out a loan with the bank of up to $24,500. This expanding banking infrastructure, with its emphasis on large, long-term loans backed by landed and enslaved property, was critical to the development of the frontier South during the 1820s and 30s. And it marked the pinnacle of the financialization of slavery in the United States. And these plantation banks were based on sophisticated financial concepts. While Southerners might not have had the jargon to describe these ideas fully, they had found a way to monetize their human property. Enslaved labor had always been first in input in production, generating profitable crops for a global market. With the closing of the international slave trade, enslaved people became a store of value for owners, particularly given their positive rate of natural increase in North America. Slaveholders could not only buy and sell people as needed like any other asset, but they could literally grow their wealth by breeding enslaved children. Yet this substantial investment in land and human property was not very liquid. It tied up capital and limited further investment in the region's economy. Frontier banks, these plantation banks, solved this problem by allowing slaveholders to leverage their stored value in enslaved people. Slaveholders could now borrow against the market value of enslaved bodies in anticipation of repaying the debt, either from future profits or the appreciation and value of the enslaved life itself. Like a home equity loan, they could tap into the value of their human property while still enjoying the full advantage of their profitable labor, their natural increase, and their appreciating market value. Even more, enslaved people became abstract, fungible assets as part of these bond instruments that could be bought and sold on the world's most modern financial exchanges. And unlike the slaveholders, traders of these instruments could remain willfully ignorant of the enslaved lives upon which these investments were based. Now, the success of both the plantation banks and the traditional banks that were also engaged in large long-term lending secured by property depended on the market stability of the underlying assets, the land and the enslaved people. And even with the memories of the Panic of 1819, no one was prepared for the possibility that the economy might again collapse. And just as leverage multiplies the wealth-producing effects of an asset in good economic times, it greatly exacerbates the losses in a downturn. And Southerners quickly found that they had over-leveraged their human property, and they needed to figure out how to disentangle these enslaved lives from the collapsing banks without destroying the system of slavery itself. The panics of 1837 and 1839 and the resulting recession highlighted the shortcomings of relying so heavily on human property and credit relationships. Unlike the previous panic of 1819, when banks really had only a limited relationship with the system of slavery, frontier banks in the 1830s had become so dependent on slavery that they faced two equally bad choices when the panic hit. They could foreclose on slaveholding customers, sell their plantations and enslave workers at a severe loss, excuse me, or they could renegotiate more lenient terms with the debtors in the hopes of a quick economic recovery. Especially in the case of the largest debtors, the banks often treated them as too big to fail, repeatedly renegotiating loan contracts to avoid, at almost any cost, the seizure and sale of land and human property in the midst of the downturn. In this way, banks frequently, if inadvertently, prevented the large-scale breakup of enslaved communities that was often the hallmark of foreclosure proceedings. And in those cases where the bank did ultimately decide to foreclose, it still had to choose whether it was better to sell the property immediately, potentially at a great loss, or to take ownership and managerial responsibility for the whole plantation with its enslaved workforce until market conditions improved. Having invested so heavily in plantations and enslaved lives during the 1830s, most banks chose to prop up the system of slavery rather than oversee its systematic collapse. By serving as a financial safety net for slaveholders during the Depression, frontier banks helped lay the foundation for the Southern economic boom during the 1850s. Yet despite this tendency towards leniency, banks often did find it necessary to foreclose on certain debtors. And even more so than during the early 1820s, Southern banks of the 1840s faced extended foreclosure lawsuits, greater instances of fraud, and other challenges related to long-term mortgage contracts. Foreclosures were not only complicated by the claims of multiple creditors and the confusing counterclaims of widows and heirs, but also newer difficulties, such as the release of a debtor's obligations through federal bankruptcy proceedings, and the flight of debtors with their enslaved people to the Republic of Texas. Even in the case of successful foreclosures, banks often found themselves saddled with owning and managing plantations with their enslaved workforce, property they were either unable or unwilling to sell at the going market rates. And when they did sell, the enslaved communities on these plantations was often devastated, as people were sold in small lots to the lowest bidders and the community was scattered. The willingness of banks to embrace long-term mortgages on land and human property and their leniency towards many delinquent slaveholders during the Depression itself ultimately resulted in the failure of a large percentage of banks, particularly in the frontier South. And these failures had wide repercussions for both the debtors and the enslaved men, women, and children who had been offered as collateral. In effect, many frontier banks sacrificed themselves at the altar of the slave system. Slavery would survive, but at the expense of the banks. The ultimate lesson of the panics of 1837 and 1839 was that the financialization of slavery was extremely risky. The benefits of long-term lending on enslaved lives during the boom times were mirrored and magnified as disadvantages during the downturn. In the aftermath of the collapse of the banking system, frontier Southerners found an easy scapegoat for their financial woes in the banking system, and now rejected banking outright as a viable option for financing a slave economy. Although banks had played a critical role in the expansion of the slave economy during the 1820s and 30s, and had successfully helped to navigate indebted slaveholders through the panics, They had been merely a means to achieve the financial end. Even as the slave economy triumphed and cotton became king during the 1840s and 1850s, frontier legislatures rejected the continued dominance of banks in the financialization of slavery. By the 1840s and 50s, the innovative financialization of slavery by formal banking institutions was no longer necessary. By facilitating rapid expansion into the southern frontier during the 1820s and 30s, and then providing stability for slaveholders during the Depression, frontier banks had successfully entrenched plantation slavery in the Southwest, paving the way for the region's economic boom by mid-century. Only the most capital-intensive sugar planters remained dependent on state-chartered commercial banks. When frontier legislatures reconsidered the role of banks by the 1850s, they were no longer seeking novel financial solutions for an emerging economy, and they could instead return to the more conservative structures of traditional banks. As legislatures aggressively pushed back against bank financing of slavery, slaveholders were forced to pursue other methods of financial support. Private bankers, out-of-state bankers, and merchants attempted to fill this void, but most lacked the economic resources available to incorporated institutions for financing large-scale endeavors. The most successful of these newcomers would develop into some of the nation's investment banks, but that's a story for another book. Several Deep South states would eventually reconsider the wisdom of their anti-banking policies during the 1850s. Yet in doing so, they would return to the traditionally conservative banking principles of the North and the Eastern Seaboard, explicitly rejecting the innovative banking practices that had driven Southern financial development during the 1830s. These new banks were less accommodating to the financial needs of slaveholders and the slave system. Banks on the southern frontier had fulfilled a specific need during a crucial moment in the expansion of the slave system, and then they retreated into the background. Thank you very much.
Do we have questions?
Do you have any sense of the absolute numbers of enslaved people who were sold away from their homes and families as a result of defaults of their owners?
I wish I could give you a number on that. It's so hard to track. Most records, most of these banks failed, so the records are piecemeal. Scholars who have studied this have made estimates of how many people overall were sold away, but it's nearly impossible. It's a big number. It's a big number, but it's nearly impossible to actually pinpoint it because of the spotty nature of the records, unfortunately.
We have a question online from Saunders who asks, how many bonds were sold to people who lived in the northern part of the country?
So a lot. Most of the bonds that were sold by these states, and so we have state bonds being sold not only for these plantation banks, but for a number of other things. Most of them were sold out of state, were sold in the Northeast or overseas. When the banks fail, a lot of these states repudiate these debts, and they kind of like refusing to pay off their debts that they promised. I don't know if we have any conversation about this going on lately, but they refused to pay off the debts, and this actually really hurt them during the Civil War because a lot of European countries said, you've already repudiated our debts once, we're not going to do it again. So it is a very large number. How much the buyers knew what was backing these slaves? Now, obviously, backing these bonds, they obviously knew they're backed by, say, the state of Louisiana, which is a slave state. How much they know that it's directly backed by enslaved people and plantations is less clear. There's actually a scholar, Dave Thompson, who's working on a project on these repudiations. So I'm hoping maybe he'll be able to answer some of this. But so sorry, again, I'm batting 0 for 2 on having a good answer for these questions. So maybe someone give me an easier question.
So we have a question. Why did the banks prefer enslaved people to other forms of collateral?
So initially, they preferred it because they were more liquid. So imagine, you're using land as collateral. You can't move the land. You can't break it up easily. So you have to find just the right buyer for that land. But if you have 50 slaves, you could sell all 50 at once, or you can break them up into different groups. And so they actually found that and you can move them around. You don't need someone in Fairfax, Virginia to buy your land. You can, take those slaves from Fairfax, Virginia and sell them anywhere. So they were much more liquid and easier to sell. And that's why initially they thought, but then they found, well, that also means that it's easier for a slaveholder who's a debtor to abscond with you can't abscond with your land, but you can abscond with your slaves and take them to Texas and disappear. Or you can, fake a sale of your enslaved property a little easier than you can fake a sale of land. So they found that had repercussions, that the liquidity aspects of it.
Can you tell us more about how you went about your research, and how did you pick the archives to go to?
So initially, this was a very frustrating project because initially I thought that I should start with those large state banks on the Eastern Seaboard, and I was going to find all sorts of stuff. So I went down, and some of my first research trips were to Virginia and North Carolina and South Carolina. I'm getting into these archives and finding nothing, or I'm finding just enough to keep me in the project, but I'm just frustrated. And it's not until I started getting into Alabama, the State Bank of Alabama. When it folded, the repercussions are huge. I have a large section on what happened when the Bank of Alabama fails. And all those records are in the archive. And I was like, I said to my husband as I was traveling around, there would be sometimes where I'm just looking for needles in a haystack, and sometimes I'm shooting fish in a barrel. And Alabama was shooting fish in a barrel. I mean, I got there and everything was about slavery. Louisiana again. So it wasn't, and that's when I started. Oh, wait a second. Maybe I'm treating the South as one entity. And it's not. And we have the settled South and we have the frontier South. And once I started thinking about it that way, it changed my story quite a bit. My initial story was going to be more of a general Southern story, and then it became a frontier South story.
Yes, when you were showing the names of the slaves during the bank sales, was that strict? Were they strict to do that all the time, or because that's really something to see, where when you see the census, it's nothing.
Right.
But you go to a bank and you're doing a loan, and their name and their age is there, and it makes me wonder, is that across the South and North? Is that documentary throughout? For
the bank collateral, yes, because they wanted to make sure that what they were mortgaging, what the value was. They didn't want people substituting. So they didn't want, we mortgage these 50 slaves and now you give us 50 slaves that are all old and dying or all infants. And so they were very strict. So these lists that we have are pretty much across the board. And when we don't have them is when we often end up with court cases arguing over, that's not who you put up as collateral, you put up someone different. And so, these lists are pretty extraordinary. And you'll have, especially in Louisiana, where the largest loans were, you'll have lists of 200 to 300 slaves on these documents. And it's really quite, it really takes your breath away when you see them, and they're divided up, men, women, children. Sometimes they're divided into family groups. Most of the time they're divided into men, women, and children. And, but yes, they would list them. Unfortunately, and a lot of people have asked me about this, very rarely are their last names included. So almost always it's first names, sometimes a descriptor, sometimes they would have a racial descriptor. But most of the time, it's just first names or, Susan and little Susan, and stuff like that. So it's not easy to really research, family histories through them, unfortunately. I did have a Boy Scout contacted me when I was early in this project, who was working on a project, his Eagle Scout project in Louisiana. He wanted to, the Plaquemine parish that I showed you the list from, is now a state park. And he wanted to put up signage of the history of the plantation history there, and he wanted names. And so I was able to give him names of some 200 people who had been enslaved on that plantation, and so made it onto this plaque that he dedicated. It was really, I couldn't go down for the dedication, but it was really quite extraordinary. And he actually, he filmed it. He had friends of his got up and they named every single person, and they took turns going through the names. It was really quite extraordinary. So yeah, but this was actually quite common to have the slaves listed by name, age, gender.
We have another question online that's asking, usually collateral has to be appraised to assess how much it is worth to secure a loan. Did you come across any discussions of how enslaved people were appraised?
Yes, they did have appraisals. And so the bank would send out normally, now, usually the people who know the most about the slaves are slaveholders themselves. And so often it's the slaveholders themselves doing the appraisals, but they would send out appraisals. And I have a couple, not as many as these documents. These documents are formally filed legal documents, but the appraisal documents you would find, and they would have discussions of the actual valuations on them. So these documents usually just had the final valuation that they gave, but there are appraisals talking about that and talking about all the value of all the property. And so they would be talking about the buildings and the land, and then they would have the listing of the enslaved property and their values as well. And sometimes you would also then get other things like occupations as well. You often didn't get occupations in these documents, but the appraisals would often include occupations.
And for those of us joining us online, I hope that you will consider buying a book from your favorite online retailer, perhaps bookshop.org. And thank you very much for a great presentation.